Gold just started charging rent. And it's already beating the Treasury. Not next year. Not if rates fall. Right now, April 2026, gold crossed a line no reserve asset has ever crossed before. The IMF updated the special drawing right valuation on April 1st. That wasn't just an accounting tweak. It was a legal mandate. Gold is now officially yield eligible collateral. Not just weight verified, not just purity tested, but rent collecting infrastructure. Within 72 hours before most central banks had even circulated the memo, Bloomberg Terminal flashed a live trade. Singapore, cross-currency swap, gold-backed, 3-month tenor. Yield, 4.97%. That's not a forecast, not a model, not a whisper in a conference room. That's a cleared, settled, auditable transaction. And it beat the 3-month Treasury bill by 82 basis points. Let that settle. You've spent decades hearing gold is a store of value. Passive, silent, waiting. But stores don't charge rent. Landlords do. And for the first time in modern monetary history, gold just handed out its first lease agreement. Here's what that means on the books. Fred Data, the Federal Reserve's own database, shows monetary gold revaluation spiked $11.20 billion in Q2 2025. That's the largest quarterly jump since 2012. Not because prices rose, because status changed. Central banks didn't just hold more gold. They reclassified it from inert asset to yield-bearing collateral. That $11.20 billion wasn't appreciation. It was infrastructure upgrade. Think about it. When was the last time you heard of a reserve asset charging rent, not promising yield, not hoping for appreciation but collecting it, in real time, across borders, under international law? This isn't speculation. It's settlement data. It's ledger entries. It's the moment gold stopped being held and started being leased. And the dollar? It's still clearing invoices. But for the first time, it's not the only thing collecting rent. Here's how gold charges rent. Not with a bill. Not with a contract in fine print. With a vault door opening. A bar scanned. A ledger updating in real time. A gold repo swap is simple. One party lends cash. The other posts physical gold as collateral. That gold sits in a regulated vault, London, Singapore, Zurich, under strict LBMA rules. Title transfers. Custody is verified. And the lender receives not just repayment but rent. A premium, paid up front or in installments. That's it. No algorithms. No black boxes. Just gold weighed, stamped, tracked, securing real cash. And right now, that rent is 4.97% annualized for 3 months. Which is 82 basis points higher than the 3-month Treasury bill. Why? Because lenders aren't being paid to hold gold. They're being paid to release dollars. Think about it. When you lend $10 million against gold, you're not betting on price. You're trading liquidity for certainty. Dollars are instant. Gold is portable, jurisdictionally neutral, and legally verifiable. A bar in Singapore answers to no single court, unlike a digital claim, a bond, or even a Fed account. That neutrality has value, and the market just priced it. So the rent isn't for storage. It's for risk transfer. You take the gold, its weight, its purity, its chain of custody, and you hand over cash. The borrower uses that cash now. You hold the bar and collect rent until the deal ends. No trust required, just verification. Every bar has a unique assay stamp. Every vault receipt is timestamped to the millisecond. Every custody trail is anchored to a public ledger auditable by any central bank, anywhere. Compare that to a Treasury bill, a promise, a line on a screen, a claim on future tax revenue. Gold? It's a kilo of metal with GPS coordinates, a serial number, and legal title that survives sanctions, seizures, and server outages. That's why lenders demand more than T-bills. Not because gold is safer, but because it's sovereign-grade infrastructure, and infrastructure collects rent. So, the next time you hear gold yield, don't picture a dividend. Picture a vault, a barcode, a signed receipt, and a payment arriving, on time, in full, because the bar didn't move. It just started earning. That $4.20 billion didn't vanish. It was redirected. In Q1 2026, short-dated Treasury ETFs, the ones holding 1 to 3-month bills, lost $4.20 billion in assets under management. Not slowly, not quietly. In 1 quarter. With receipts. And where did that money go? Into gold-backed ETFs with physical delivery options. not paper gold, not futures, not leveraged plays. ETFs where, if you hold long enough, you can walk into a vault in Zurich or Singapore and take possession of the actual bars. Those ETFs saw volume surge 217% in the same quarter. That's not a rally. That's a migration. Think about what that means. Traders aren't just buying gold exposure. They're buying yield 4.97%, paid in cash plus the legal right to claim the metal itself. Two things treasuries can't offer: rent and recourse. Now watch what happened to the yield curve. In March 2026, the exact month those ETF flows spiked, the front-end yield curve flattened sharply. The spread between 1-month and 3-month treasury yields collapsed by 67 basis points. That's not noise. That's traders abandoning dollar liquidity at the shortest maturities, precisely where gold's repo yield is most competitive. Why? Because at the front end, the trade isn't about inflation or Fed policy. It's about collateral efficiency. Dollars are fast, but gold is sovereign-grade insurance. And when the premium for that insurance hits 4.97%, the math flips. Suddenly, holding a T-bill isn't safe. It's expensive because you're giving up yield and jurisdictional optionality. That's infrastructure arbitrage, and it's happening live. Now look at who's driving it. Central banks deployed $120 billion of gold into active settlement channels in 2025. Let that land. $120 billion. Not stored, not stacked, not held in reserve, deployed as leasable infrastructure. That gold is sitting in LBMA-approved vaults not as inert bullion, but as pre-verified, title-transferred, swap-ready collateral. It's been loaded onto settlement rails used by the Bank for International Settlements, the ASEAN swap arrangement, and bilateral central bank agreements. This isn't preparation, it's operation. Fascinating and undeniable. Because this isn't sentiment, it's settlement. Every ETF trade, every yield curve tick, every central bank ledger update, they're all confirming the same thing. Gold isn't waiting for permission to earn. It's already collecting rent, and the money proves it's not speculative. It's structural. The dollar still clears 87% of global trade invoices. But gold now clears 31% of central bank bilateral settlements and pays rent for the privilege. So ask yourself, if the world's largest balance sheets are treating gold as yield-bearing infrastructure, why does the dollar still get to charge zero rent on its own settlement layer? That's not a theoretical question. It's the pressure point building right now beneath the surface of every treasury print, every ETF flow, every vault receipt. The money has moved. The question isn't if the dollar can compete. It's whether it even knows the rules have changed. Here's the rupture: clean, structural, irreversible. The dollar still clears 87% of global trade invoices. That part hasn't changed. What has changed silently, legally, and with ledger-proof finality is where the money stops. Because gold now clears 31% of central bank bilateral settlements. Not as a backup, not as a hedge, as the yield layer. Let that sink in. Every time two central banks settle a debt, say, Brazil pays Indonesia for oil, they don't always move dollars. Sometimes, they move gold. And when they do, gold doesn't just clear the payment. It charges rent for the privilege. That's not theory. It's happening right now in BIS-linked channels, ASEAN swaps, and direct central bank agreements. So here's the architecture plane. Top layer, transaction clearing. That's the dollar's domain. Fast, liquid, ubiquitous. 87% of invoices, yes. Bottom layer, settlement collateral yield. That's gold's domain. Portable, neutral, legally bulletproof. 31% of bilateral settlements and growing. This isn't de-dollarization. It's dual collateral architecture. One system, two layers, and only one collects rent. The dollar handles the movement. Gold captures the yield, which means for the first time the dollar's dominance has a ceiling. Not a floor, a ceiling. Because yield is where pricing power lives, where leverage lies, where control over monetary gravity lies. So ask yourself, if gold earns 4.97% on settlement collateral, why does the dollar charge zero for clearing the world's trade? That asymmetry isn't sustainable. It's already distorting behavior. Traders aren't waiting for war headlines to buy gold anymore. They're watching swap desks. They're watching LBMA vault receipts. They're watching the yield spread, not the price chart. And that changes everything. Because the next time gold breaks $5,000, It won't be on a missile launch or a tariff announcement. It'll be on a Bloomberg terminal print flashing gold yield plus 0.91% versus T-bills. That's not speculation. That's infrastructure speaking. The dollar built the highway. Gold just installed the toll booth underneath it. And it's already open for business. The question isn't whether the dollar remains dominant. It's whether it can survive not being the one who gets paid.